Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. This is fun. I'm excited. We're not on Zoom. I saw one of our old meetings or our old recordings. Like, oh boy. It was us sitting in our basements 5 years ago.
Oh, from my house before.
Yeah. It was your house before. My video. It was on Zoom. I'm excited, Pat. What I wanted to do, as we were saying right before we hit record, is so let me share a story with you about like where I'm at, and I think it'll help us put a container around the conversation. So what I learned from you about the financials and how I learned it, I think has been one of the most impactful things about how I'm managing my life, my clients, my own business, and my own decision making. And like what I continue to say to people is like, it's just not subjective. You either have cash or you don't. Your balance sheet ties out or you don't, or it doesn't. And it's understanding how all of the numbers of the three statements fit together to result in cash. And what I learned from you is, because I came at it from the operational side, going, okay, I understood what it meant to juggle cash and people and all that stuff. And then it was kind of like, I saw the matrix after you showed me how the three statements connect and like the different, jargon and vernacular that people use. At the end of the day, you either have cash or you don't. And so I say that from the financial side, but also as the last 5-6 years of what the gold standard is also as what a CFO should do and what their actual responsibilities are. And then what it's given me, and I think given a lot of as I share it with my clients or the Vistage groups, is what should you expect? Because a lot of these people don't have a finance or accounting degree. So then they get nervous when they're interviewing people, or they get, they don't know what they don't know.
Questions they ask.
Yeah. I had one of my clients go, Ryan, this is not a boiler. And this is what? Not a boiler, because he sells boilers and services boilers. And I was like, fair enough, Darren, it's not a boiler. And so I say all that because what I wanted to do with this conversation, and we'll put the links to your and I's previous episodes in there where we kind of walk through the roles of controllers versus accountants versus CFOs. But today is just talk about like what you do and like what your expectations are for like when you sit down with a shareholder, whether it's an ESOP or an owner, like what do you view your job as, and like how do you view that relationship that you have as the CFO with the ownership group?
Okay. Do you want to not talk about the three statement model and building up to it?
I do, and because I appreciate that. I can kind of lay a couple of the stepping stones. I'm thinking about talk about the three statements, talk about then like kind of like the monthly package, Pat, where it's like the three statements connected together, what you're looking for inside them and why. How then you look at the history, and then we'll talk about budgeting and your role in budgeting, and then also the out year and then M&A. But like I think about like at any given point, you're blocking and tackling with this ownership group, and they have to have some sort of clarity on what the hell they want and why for you to do your job, right? But you're kind of like calibrating them so you can do your job. But like maybe kind of like I think a good place to start is like what you view your ongoing relationship with that ownership group to be.
Yeah. And a lot of them struggle still. It's a process of them learning how to be an owner. They know how to install boilers or, make things or fix things, but they don't know how to be an owner. It's not innate.
What's your definition of being an owner?
Being an owner is looking at the business, looking at it. You have a duty as an owner to grow the value of your asset, which is the business. That's your responsibility.
Whatever asset that is, right? But real estate or a company. I mean, that's...
I'm thinking about a company.
Yep. But I think just in general, right?
Yeah. I mean, that's your job as an owner. You got to, you could be the sole shareholder, so you can ignore it. But when you ignore it, then you have a lifestyle business. Nothing wrong with that, but acknowledge it.
That's what I love. Just fine. Just call it what it is. And I think I
had that argument with, flat out argument. I said, you guys have a lifestyle business. You guys you have these companies to give yourselves jobs. No, we don't. I'm like, yeah, you do.
Well, and so here's what's so fascinating is because I think about where that's coming from because of like when I also think about the numbers, and it's like mechanically with a business, you have like there has to be intentional thought of, do I reinvest this cash back in, and what is the return and what timeline? Because we have to reverse engineer the math. And if we don't have that visibility, then you literally can't do your job as a CFO. So understanding reinvestment versus distribution tied to what like becomes impossible for you to do your job unless someone articulates it.
And you got to have a plan. I saw Greg Meredith last week, and having a plan. What is it? What's it going to look like? What do you want in 3 or 5 years? That impacts a lot of those decisions that you make about reinvestment or taking the money out.
So like, what is the mechanically, like you're having to figure out how much cash do we have, and it maybe like the kind of this is where I've been honing in on, Pat. Since you and I've been doing our work together, which is like any of our clients or my clients, it's like, okay, how much cash do I have after working capital, debt, taxes, reinvestment? Do I reinvest or do I have cash? I mean, like it's that after the cash flow from operating activities and the cash flow statement become the owner's decision tree, but it has to be tied to something with a lens to say, okay, like, and you as the CFO, that's like one of the core principles. And then you're reverse engineering all the operations and the financials to get to that point, right?
Yeah. I mean, it's the role of the CFO is to be that strategic financial partner with the owners to help them achieve their goals, whatever they are. So you got to have goals, but then you got to have really good information in order to do that. And you're saying, how much cash do I have? And I think what you mean, but correct me if I'm wrong, cash flow. What cash flow is the business generating? You could have a lot of money in the bank today, but that doesn't mean things are going well.
Correct. And
I mean, you could have a business where people pay up front. We have a friend who's, they get their money up front. So you could have a lot of money in the bank today, but that doesn't mean you're doing well. But what cash flow is the business generating from its operations? Whatever business you're running, what cash flow is that generating? Then you get to decide what to do with it. Reinvest by buying new equipment or, different equipment, taking distributions, paying down debt, increasing your equity value, in the business. But the cash flow from operations number on the statement of changes of cash is probably the most important number in the financial statements, over time. And people don't look at it. People don't have the number, first of all.
Let's talk about why. Before we talk about why, here, I want to add to that because, like, I agree with you, and I did mean cash flow, but did. Well, and actually, like, in the way I've been, you can correct me or modify how I'm saying this, is like, at the end of the day, when I look at the 3-statement model that you trained me on, it's like we're trying to predict the cash position in every month, which is the cash flow, but like it's ongoing. So it's like, and so if I look at the operating activities, I'm like, you did all these things in your income statement, and then you've got inventory, receivables, payables, and all that working capital. And then there's your operating cash flow. Then the ownership decisions start coming. Is that a fair way to put it?
Yeah. And the ownership decisions are investments, new equipment, new locations. Am I going to open a new office in Phoenix, or what is it? And paying down debt or quicker, or don't pay it down quicker, depending on what it is. And distributions. Is it just a business where you want to take out every dime you can? Okay.
Mm-hmm.
It's not
just say it then.
Just say it. Yeah, just say it. It's okay.
There's no judgment. It's just
no. But then don't be upset when the value of the business doesn't grow.
Right.
When you go to sell it and you can't find any takers because they're like, there's no value here. Which is okay. There are a lot of businesses. 95% of the businesses in this country have revenues below $1 million or whatever number. Is that you used to talk about
95% below 5 million in revenue.
Below 5 million.
Which you and I both know. I mean, after gross profit, net income, taxes, working capital, all that stuff. I mean, it's not. There's as this CFO, as you walk through all that stuff, and I think this is the thing that I have seen that a lot of people struggle with. They have controllers, and so like what happens is all of those decisions fall right onto their shoulders. They're a boiler, they started as a boiler tech or an electrical contractor or a nurse or you name, or a steel fabricator, you name it. And it's like not a CFO. And then it's like, okay, all of those decisions that I don't know, like I know I need to make, I don't see the whole picture. And then it's like, okay, well then what ends up I see is like, because of the 3-statement model, we can get into like kind of I think this is how we'll unpack it all. It's like, they have like pieces of the puzzle. They don't have then the confidence that it all ties together. And so then they have that anxiety and that frustration, like, okay, I'm the only one that can worry about this stuff versus, and they're missing someone in your role that is owning that whole situation.
Yeah. And, having accurate financials is the starting point. And it's just astounding. You and I have seen over the years how many people, that we've started doing work with in the old days, just didn't. People I'm working with today, they just don't. Exactly. You look at them and you're like, so and they know it in their gut. The financials show I'm making money, but I'm never getting cash. Why is that? Or I just having to keep borrow. How many times people borrow money to pay themselves?
Well, no, and I want to get to the clean financials and what your definition of clean is and what data we need in order to get these decisions. But just to put a bow on the CFO, like the whole like when we look at the finance or the finance function in the actual income statement, we have someone that should be in charge of revenue, someone that should be in charge of gross profit, and then someone that is in charge of the finance function, whether it's EOS and like oddly enough, those 3 functions tied to the income statement, but the CFO is literally taking all of that responsibility and owning it. And so when you're showing up for a monthly ownership meeting, whether it's a PE-backed company that you've worked for, or it's an ESOP, or if it's an individual or partnership, walk me through or us through like what is going on in that monthly meeting. And then we can back into like, okay, how do we then engineer that experience?
Yeah. So under the assumption you have good, clean financial statements. I mean, that's the underlying assumption.
I'm not willing to move forward unless we get.
I can't let go of that.
But that's what, and I think, let me jump in there for a sec, because what I want to do is stretch the gap for everybody, saying like, because when I say like, I want us to be able to engineer the experience you're about to talk about, because I think it's what everybody wants, but they don't know how to go from where they are to there. And then that's what I think we can do is kind of unpack what are the steps necessary to create the experience you're about to walk through.
Yeah. You and I in our course used to teach that, you had your owner hat and your management hat. The management hat is, are things running well? Do we have the right tools? Managing the cost, this kind of thing. When you get to the owner level, you have to have the discussion, is what we're doing creating value? Because I'm assuming, under the assumption that's what they want to do. They want to create value. They want to grow the value of that business. Those are the people I want to work with. That are like, okay, we have a plan for 3 or 5 years out. We want to become an ESOP. We want to just get the value up. I'm 60 years old and I want to sell in 5 years, or I'm 35 years old and I just want to keep growing the value of this thing. That doesn't have to be
which is more sustainable, predictable, transferable cash flow.
Well, and right? then that opens up and to your stuff of giving you more independence. Then I have choices. Then I can make. And the choice may be I'm going to continue to work 60 hours a week if that's what they want to do, or they want to hire somebody, to get the cash flowing up so I can hire a president or CEO and then just be an owner. But the owner's discussion has to be about the value of the company today. What do we want it to be? And do we have the right plan in place to get there? If you're talking about, the cost of office supplies as a percent, has grown 10%, you're on the wrong track. The ownership hat has to be worn in those conversations where you're talking about the value of the business.
And as the CFO, you're talking about the value of the business with the ownership team and bringing the data to have those conversations, because like the way I've talked about it on some of the boards that I'm now on is like our goal as the board working with the management team is to be able to predict the future with the highest level of certainty possible. And then all of our conversations around how do we mitigate risk and predict the future, and then it becomes then data and like, but like you're sitting there in the finance function saying, okay, if you take all these assumptions, here's how to allocate capital and how that all works.
And you do that through, here's what this year's looking like, and we've got a budget for this year, and here's how we're working against it. Here's what the next 2 or 3, 4 years, whatever time frame you want to go out, when you're out your projections, and say, are we on track? Are we on track to achieve the goals that we want? And if you are, great. Just keep monitoring it and doing that. But all plans run into roadblocks and speed bumps.
But you can navigate it. Like when Jimmy Fritz was talking on the podcast, you two in COVID you had a plan, but then things changed and you're able to use that to modify it. So let's talk about so let's give everybody kind of just a snapshot on the 3-statement model you and I have been talking about now forever. I'm
going to interrupt you. One other thing is a CFO when you're in that owner meeting, it's not just here's the data, there you go, thank you very much. Send me my check. It's you've got to be that strategic financial partner, to help them navigate through those things. Because as a CFO, you see it all. Everything ends up running through one of the financial statements, everything that happens on the company. So, helping them navigate that and, help them with the planning and doing that. Most CFOs bring pretty good insight, into those things. So it's not just a matter of handing off the data. It's being that strategic financial partner that helps them achieve their goals.
Which the way that I have been describing it since I got exposure and the hundreds of CFOs that I've come across, and it's like some of the big qualifications, and maybe this is a good sidetrack before we get into then the clean financials and what that monthly package looks like and how you actually build out this structure. But the CFO disproportionately understands, compared to other people, how operations and the ideas of operations land on the financials to result in cash flow. So it's not just like, here are numbers, we have no idea. So if I, as the ownership group, came in and said, okay, we have 3 different product lines, one's 35% margins, one's 40% margins. We're trying to figure out like, which one do we scale? How do compensation plans work? How do we buy a company? Like, you're the one that's taking those ideas, which is why when I met you, I'm like, oh my God, my ideas can actually be like put into reality. Cause like, I think what happens is, Pat, a lot of the people that you and I have worked with, they're idea people, but like, if they have an idea that they can have someone like you put that idea into place and be like, you have no money if you do this in 24 months. So they'll do something different. But it's like, then do I fund it with a line of credit? Do I fund it from cash flow? Do I raise some money? Like, it's just like connecting all of these ideas. And the CFO who has operational and financial capital allocation expertise is able to bring those ideas to light.
Yeah. Well, and to show here, strategy is choices. So what are the different choices? Where do we end up if we make these choices under these assumptions? And being able to do that and predict, that's a big word. You need to be able to predict the best you can. It's never going to be perfect, but at least it's not flying blind, every day.
And one of the things that I think is also helpful to, before we move on to the clean financial statements, because of how important when I met you, you weren't just a finance person, you understood operations. And then after how was it? We were interviewing 100 CFOs at the time. Oh my God. Like, I learned a lot in that crash course years ago. And so I want you to correct me or add to, based on kind of how I have seen this, is like, okay, well, when you look at someone that's a CFO, first of all, there's no like certification, right? So like, any
Joe Blow can call themselves a CFO.
Yeah, right. Personal CFO, middle market CFO. But like, so here's what I have identified as something that's super important to get to the expertise that you have, which is I understand operations, I understand capital and the financials, and then you're able to present those ideas in a way that's actually accurate, right? It's not just made up, but it's perfectly accurate from the financial and the math. It might not be accurate from the ideas, but so people in the CFO space have come from either accounting or finance. And that was one of the big things I was like, oh, interesting, because accounting is how do the numbers get on the general ledger? And then finance is like, how do we model forward? But like when you and I, when we were going through the CFO interviews, it's like, okay, well, someone that went through public accounting, they're moving numbers in boxes and counting widgets while they're at the CPA firm. And we don't want to be the first person that hires that person out of your face. No, we don't. Yeah. So there will be this hop from public accounting to a business where then they're all of a sudden managing working capital and payroll, which is a whole different whole different ball game. And then the finance people are looking at modeling, but they're assuming that the financials are correct. So maybe can you expand on this? Because I think it's super important.
The controllers, a lot of people who claim to be CFOs are controllers. Controller job is really important, but their job is to produce accurate and timely and useful financial statements at the end of every month. When they can produce those, they can check the box. Their function is done. A lot of responsibility, a lot of work goes into that. But then the CFO's job is to take that and use that information and knowledge about the operations, the sales, and the owner's goals, and just kind of blend all that together to say, are we on the path that the owners want to be on, and understanding that. So it's different than just being a controller and producing good financial statements.
Which you would recommend, or not recommend, would you say, or it's an accurate statement that a lot of CPAs that come from accounting firms land in at the controller's job first, and then if someone has been in a business for a long period of time, and like when I think about like the CFO, it's like, okay, you've run a couple of different companies, you understand like all of how operations impact the financials. So then it's processes, procedures, but you're working with the bank, investors, you're like the CPA firm, because you're responsible for all three statements and the plan, but it's based on that clean, accurate foundation. But there's a path that a CFO usually takes where I was on a call with one of our mutual contacts, and the CFO was interviewing for the job, never been in an operating business, tax returns.
That would be tough. That'll be tough.
Why would you say it's tough? I agree, but
because they're so specialized, and it's they just haven't lived the life of knowing the impact of decisions that are made. An owner of a business will make a decision, and I'm like, okay, if you do this, here's going to be the outcome.
Define your definition of outcome. I have it. How much cash flow you have?
How's it going to affect cash flow?
Right? Because I think it's important constantly. That's where you're coming from all the time. It's will we have cash?
Yeah, and so when you have such a specialized view, whether it's tax or they've been a cost accountant at some bigger company, or a manager at some CPA firm, that's all well and good, but that's not a CFO role. That's just not. And so, calling it what it is fine. I talked to somebody that one of your friends actually referred me to, and they have a CFO, but they're probably more of a controller. And, they're like, can you mentor them? And I'm like, oh, it depends. It depends on if they have the mindset, of getting past getting past producing accurate financial statements. That's a hugely important thing. But some people, that's what they love to do. That's what they're good at. And they can have the role of CFO, but they're going to just gravitate towards what they love and what they do. It's just human nature.
Because back to the CFO, understand the operations, procedures, and processes and the ideas is, Pat, I would like to launch a new product, and I want to buy a company and take distributions, and I need to understand my line of credit. Like those are the decisions that you're helping synthesize, and which takes a long time for a controller to get to that level of like, how does this all connect?
And you have to be willing to speak truth to power. You got to be clear with owners. People who are visionaries like yourself. 100 ideas an hour. It's okay. It's great. The world needs that. I don't have 100 ideas an hour. But you got to be able to say and demonstrate and say, if you go down this path, here's what will happen to your cash flow, your ability to take distributions, or you're going to have to borrow money to pay yourself. Is that really what you want to do?
Wouldn't that be nice to know?
Yeah.
right? Like
Yeah.
that's like what you and I have said for years. Wouldn't that be nice to know? There's no right or wrong answer. It's about taking your goal. Like, and I think this is where it's so fascinating. Then I want to get into the components and how you actually are able to answer those questions. Because what I want to do in this conversation is set the standard of like, this is what's possible for everybody. And, you and I have had different attempts at scaling a CFO services and different and I think what happens is like through conversations like this, we both want to empower people to say, whoever's sitting in that seat, we want you to understand what good looks like because you're normally used to your skill or making things or whatever. And so,
Yeah, because if you're an owner of a business, you at least need a working understanding of this to have the conversations so that you can understand what people are telling you, as opposed to walking out saying, I have no effing idea what they just said.
yeah, I was hanging out with my buddy, Brandon Henry, who manages 35 families and $15 billion. And they were in the middle of this sale and the owner walked out and said, "Hey, Brandon, what's this EBITDA thing?" And like, and they're making so much money. It's insane. And he goes, everybody's been talking about it for like 8 months. And I felt dumb asking. And and like, you're talking a $500 million company. So like, it's just back to it's the working understanding. So that way someone can interact with someone like you and know whether they have someone that's capable of doing that job. I think at the end of the day, it's like, okay, like how you and I have worked together. It's like, I understand this stuff now. You're the one pulling the levers, understanding the math and understand how to do it. I can't do that. But like together, the owner and the CFO can actually connect the ideas and the strategies to the numbers. But back to your point, it's hinged upon clean financials and accurate financials. So I think we should dive into what does good look like on like how would someone structure their income statement? And I mean, if you want to go a different direction with this, Pat, or like just however, but like the way I've been thinking about it's like, and you and I have seen it so many times, it's like, well, there's no data here. So maybe you can explain why is there no data, but then like what data is necessary and how does it need to be structured for you to make decisions?
Yeah, and tell me if I'm not going the direction that you want. Having clean financials takes some work. You think about revenue. Everybody thinks, well, recording revenue is easy. Well, depending on the business, it's not so easy. If you have a construction business, using the percent of completion method to record revenue, if the projects take 6 months, it's important to get that right. As opposed to just when the cash comes in or when you send an invoice to the customer, because you're not matching up the revenue and the expenses. So we have a mutual acquaintance and, it turns out they're not really doing that right. But that impacts, if you don't have that right, that affects the income statement. You're not really making that much or you're making more, depending on the month or the period. And it just affects everything.
Right. And like, sorry to interrupt because when I think about like, because it's the matching principle, and I want to dive into that. Because at the end of the day, it's like, okay, well, what was our revenue last month? Do we believe it? Revenue, or, line by, service line by service line, location by location, product line by product line. And then does it match the cost of goods and how much margin did we make? And do we believe that margin? And then you have the overhead and then to get to net income. But what I think you and I continue to see, Pat, is that I don't believe your gross margin at all. And so if we don't believe your gross margin, what the F is everything else mean? You can't.
It doesn't, and you just outlined it. Revenue, whether it's products or services, the cost of producing those products or services, and you get to gross profit. Gross profit is dollars. Gross margin is percents. It's just easier to talk about it that way. And then you have your SG&A, or a lot of people call it overhead, that below that to get to net operating income. You got interest and, depending on, all that stuff below the line, below the net operating income line. But, if you've got financial,
because they're not operational
in nature,
right? Because we're trying to figure out this company did what.
Yes.
Right.
Yeah. It's not in the business of borrowing money or investing money. It's where they have interest expense or interest income. That's just noise outside of the operations of the business. And so it's just so important. I have a client and we barely look at net income. We have net operating income. because that's what matters. But just getting those components right. And if you have monthly financials and your gross margin percentage just does this every month and there's no logical reason for it, then you've got a problem in your financial statement.
And I think about, like,
sometimes
go ahead.
Sometimes the systems related. It's difficult to get the information out to do that if you're in a specialized industry or something.
But at the end of the day, what we're trying to do is say, what happened last month, right? And I think about even my old business. It was like, okay, well, someone pays for a contract for 12 months up front. You have to then release that revenue.
You have to amortize that revenue recognize that revenue over 12 months.
Yep. And then, but like back to then the gross profit, it's because it's like, okay, you and I've talked and seen other people, it's like revenue is just one bucket, but it's like, okay, well, so like, because back to like, what does the owner want to see? It's like, what did we do last month? What worked? What did not work? And where do we want to continue moving forward? And it's like, so back to your point about clean and accurate financials, the discipline of the processes of getting that information in the right buckets. So it could be per product line or per location, and then making sure that the time spent from the people and the costs of the inventory or whatever it is match each of those. Because if I'm looking at gross profit percentage or gross profit dollars, it's like, I, as the owner, want to place a bet. How do we scale this company in a way that we're optimizing the margins for the one that's the most scalable? Like, but if all of that isn't correct and we don't believe it, the whole thing falls apart.
Yeah, it does. It's hugely important because, and depending on your industry, there's a lot of industry information around. Is normal gross margins 30% for our industry and we're running at 20%? Okay, why?
Wouldn't you even say that, like, a lot of those industry associations will say, how do you actually structure your income statement so you can actually agree?
Yeah, sometimes. A lot of these folks will, if you're willing to submit your financial information in, they'll give you access to a whole bunch of information. It's anonymous, but you're right. If you don't get it right down to the gross profit line, you got to stop and you got to fix that, because that's what the activities that generate the revenue and the costs associated with that are reported in that part when you get down to gross profit.
And then I think about your relationship as a CFO with the controller and the operations. It's like, okay, Pat, I don't believe this stuff. As the owner, I'm sitting here going, okay, well, it says it's 38%, but I know we're not tracking everybody's time. Is the inventory like, and like when we're like, is it all being hit correctly? And I don't know, but like, I'm sitting here going, Pat, can you help me? Because like what ends up happening to that disconnect between the owner and then the finance function is those people don't understand the operation. So then the owner is sitting there going like, all I know is I need data. But then all of a sudden my whole finance team is going blah, 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 blah. And like, yet I'm just on the hunt for data that's accurate. So you become the glue in between.
Yeah. And even, I'm a fractional CFO, so I do this part-time for numerous clients, but you've got to be integrated in the business. The CFO should know long before they present the financials to the owner that there's a problem, if there is. They should say, these margins aren't believable. We've got a problem somewhere, if that's the case. But you got to get past that. That when that happens, when the owner looks at those financials and they're like, says to themselves or says out loud, I don't believe these. The anxiety that creates is just unimaginable almost. And when you get to the point where that is solved, then A, the anxiety goes down, but then B, they're in the position to make decisions. To say, do we want to scale this business that's generating 10% gross margins?
Right. What business do we want to be in and where do we want to go becomes an actual question we can start answering. But, I was on a couple client calls, was it last week? And both of them, we got on the call and we looked at two numbers and they were wrong. I was like, what do you want to do for the rest of the call? I was like we don't believe anything else. So then what? And so but I think it's important because like you said that the CFO's job is to think about that before that happens. Right. And like, that's very indicative of whether someone has someone that's truly a CFO is when we get on that meeting and someone goes, oh yeah, you're right. It's like, okay, well, then what are you getting paid for here? Because now the owners now got that monkey on their back and they don't know what to do with that monkey. So I think back to like and that's why I think even pulling off of our earlier stories of like understanding the operations and the process and procedures, how they fit onto the financials helps solve this issue. And it takes a while to clean up those financials, but you're like, you have the whole picture in your head.
Yeah. And that's why you got to be integrated to the management team and part of the management team. You can't just blow in at the end of the month,
close the books,
put the file together that we've used and then send it and move on. That, in my mind, that doesn't work.
Agreed.
You got to be integrated into the management system, into the management team.
So, I think there's a couple ways we can launch off of that comment. Talk about annual budgeting, but also what is integrated into the operations meaning, because I think maybe we can kind of tackle those both at the same time, which is like, if you were to take over a new company, what's your process to get up to speed? Because like, I mean, it's kind of almost the same, and because that kind of probably could lean into, annual budgeting, but like, how do you integrate and how do you get the big picture?
So I'm fortunate enough to have a lady who works for me who's a true controller. I mean, she's been doing it for 20 plus years, probably. So she's the one who then gets into the weeds, working with people who are there, either they're leaving or brand new, and just digging in, so that over time, and it takes time, it doesn't happen overnight, that she digs in and does the work necessary, makes whatever changes. Of course, I work with her, through all this in order to have clean and accurate financial statements. It is just it's a big process that we go.
So you can read them, right? And here's what I'm interpreting out of that is, you, Pat, know that Stephanie's capable, so you can trust her where you're not looking over her, so you can trust her to go do her stuff, so then she can come back with the numbers. Because and if you didn't have Stephanie, which in the past you've taken over companies where there is a Stephanie, and the first thing would have to be is, do they know what the hell they're doing, so you can trust them, right?
Or I've had to do it with them, but you got to, and getting in the weeds a little bit, you got to make your balance sheets right. The way to do it is to just make sure every number on the balance sheet is supportable.
Well, I want you to actually double click into that, because we talked about the income statement, but I was on with Alan from ITR, and we were kind of shooting the shit. And he goes, "How many of your clients start with the balance sheet?" And you can I'm like, oh, Pat would have absolutely loved that comment, because he said it like as one of the top Vista speakers for 30 years. He knows how few people do that. So why is that so important? And explain why you start there.
Well, in accounting, there's two sides to every entry. So you record a sale on one side, you record accounts receivable on the other. You get money, you record cash, and reduce accounts receivable. You buy inventory. And then when you use inventory to make products, you're recording expense and cost of goods sold and reducing inventory. They are all tied together. The key is, if you go through the balance sheet and you make sure you have support for all the numbers on the balance sheet, and you know that they're right at the end of the month, and you've done that in the previous month, then your income statement's going to be right. You can have
regardless of what numbers are on it.
You can have something misclassified between this account and the other account, but your net income is going to be right. Because you've done all that work. That's the approach we've taken. When you and I were interviewing all those CFOs, we asked how they approach month end. Probably only 1 out of 20 described that process. But I have found that is the key.
And it's necessary, and you have to do that to get an accurate cash flow statement.
Yeah, because then the income statement's right. The statement of cash flows is nothing but the results of the income statement and the changes in the balance sheet. So I don't know why it's such a mystery or so difficult for people to do. I left a client, and they hired somebody to take my place, and I was working with him to transition. Nice guy, good on paper, good qualifications. And I'm like, and we're going over the file that we have. I'm like, and I'm talking about the statement of changes in cash flow, and he kind of gets this little bit of a dazed look on his face. And I'm like, so have you done much work with the statement of changes in cash flow? And he's like, no, not really. I'm like, okay.
Okay, sounds good.
I probably had to turn my camera off for a minute.
Well, like,
but I'm just, they're all integrated.
so
All three
funny.
statements
Right.
have to be right in order to really get a clear picture. What kind of money am I making? Am I managing my balance sheet correctly through working capital, debt? Am I over leveraged? You know,
All the answers
and
people
what
want.
kind of cash flow are my operations throwing off?
Right. Okay. So I just think it's so funny, and the reason I'll tell you why I think it's so funny is because through our relationship, like why I've liked all of this, Pat, so much is because it's just not an opinion.
That's not an opinion. No. Interpreting them can be a little bit of opinion, but
right. It's just like it is what it is, and so like because so
these
many
are facts. These are
yeah.
you're entitled to your own opinion, but not your own facts.
And so this is why I have liked it so much, is because I mean, I dealt with a lot of imposter syndrome and like, do I belong here? Like, do I understand what I'm doing? And then all of a sudden, like through learning all this with you, I'm like, this is just like it's math, right? Like
a lot of it.
And so, go ahead.
Yeah. Well, the math part, when you have clean and accurate financials, that's math.
Right, but like how they connect together,
and how they connect.
And so, but I want to kind of regroup on or what you said. So like your balance sheet, because it starts with the balance sheet. And it has to be accurate back. And so like some of the things that I see is people play games with their inventory. They play games with all their but so if you have games going on in your balance sheet and you're trying to like, if anybody's trying to predict the cash flow, they have to get this shit right. Otherwise they can't get what they want. So it's like, okay, well, you have to clean up your balance sheet and then you can at least see the difference. So over 2 months, then you'd have your income or net income correct, and then at least your cash flow statement's correct. Then you go back to then the data on the income statement. But like why like I keep laughing is like when I've interviewed, like you and I, when we were interviewing CFOs, or now when I interview a CFO from like one of my clients, I'm just like, there's literally a right or wrong way to do this. This is not Ryan's opinion. It's just
in the 1400s, the monks created accounting and hasn't changed. And it's not just people playing games. I can remember 100 years ago. That's
a long time.
That's a long time, man. Not quite 100, but
happy birthday.
But it was a long time ago. I was a part owner in a small printing company, and we were going to merge with
Superior, right there.
Superior Printing. That's right.
Yeah.
And we were going to merge with another printing company, and I was talking with the owner, and he's like, our income statement shows we make money, but we have no cash. And I'm like, well, let me see your financials. And he did, and the balance sheet was just wrong. Inventory was just, I said, you don't have that much inventory. We take inventory every month. We count it every month and make an adjustment. Well, the bookkeeper was adding the change to the inventory every month instead of just, recording the change. She was just kept adding and adding and adding. And, so I said, when you make this adjustment, you're losing money.
Oh my God.
I mean, it was devastating, to him. So I say that because it's so important.
There's no other way to get the information that people want.
It's so important. It's not how you feel. It's not how much money's in your bank account today. It is literally having these financial statements taken as a whole and having a working knowledge of how to read them.
Right.
And not be able to produce them. I don't expect any owner to go do the work necessary to produce them or even look at the Excel file I have and understand how it works. But they can hone in on their gross profit. Is their SG&A as a percent of revenue in a reasonable range? Are we managing our balance sheet right? And are the operations producing the cash flow that we want so that we can make decisions about investments, distributions, and all those other things? They're just all tied together. You can't understand the story, the financial story of your business without all three.
It's
I'm sorry, I stole that from you. The financial story.
Well, but it's all. These are just ways of us trying to describe to others that like this is so important, and like so many bankers or CPAs or investment bankers or private equity firms, it's like all of this jargon and bullshit is overcomplicating what most people already know. And you and I took this approach of, I think it's easier to help the boiler tech or the HVAC tech understand this than it is to teach some of these advisors how to run an operating business. And so with a level of understanding, say, hey, people have different words for different things, but the components are the same: the revenue, gross profit, cost of sales. I mean, like my point is, there's all these words that people interchange, but once someone understands the whole, and like how we're talking about right now, Pat, the way I've described it, to people is like, people think that this is more complicated than it is actually. And what my analogy is like, Peter Attia, I don't know if you ever read his book Outlive. We talked about that, I think, a while back, but it's a 500-page book about like the actual modern health of like how to be healthy. And it's a 500-page book that says, get 8 hours of sleep, walk every day, move some weights, and eat well. And it's like, and so that's what my point is with this is like, the discipline sets you free. It's like, what should we do what you're talking about now? So that way someone can pull up a dashboard and say, okay, I could read this and I trust it. The decisions is what everybody wants answers to. And like, how do we take my ideas and actually trust the future scenario? So like when you go in, you take over a company, or when I say take over a company, you're looking at the numbers, you're compiling this picture to see the story. Walk through like what you think is a good budgeting process. So that way we're engineering that like monthly budget to actual meeting.
So the key to preparing good budget is having good historicals, financials, because, except for new initiatives, you've got a core business and it's ongoing. So, what's revenue growing, year over year? If you don't have good financials, you won't know that. Most companies in the budgeting process, there are probably 10 line items that matter.
No matter the size of the company too, right? I mean,
probably, yeah.
Yep.
It's just people get focused on, I got an email from one about, boy, these costs really going up year over year. And I've replied back, I'm like, dude, those don't amount to a hill of beans. Who cares if they're going up?
Hill of beans, that's a new one.
Focus on the big ones, but look at what drives your business. What sales activities are driving your business. Predicting sales into the next year is the first place to start. If you can't do that, and that's hard in a lot of businesses.
It is, but I think what's so fascinating,
sales, but looking at the history and is it by customer, is it by location, is it by segment, product line? You gotta get to that level. Office supplies, add 3% to it for next year and move on. But
what I think is so important to highlight, which I don't see almost ever, is so if you think about the CFO has to be responsible for the financials and the accuracy of the predictions. If you're going to have revenue land on the income statement per month, why and how? And so like when I met you and when we built our businesses, it's like, okay, like you would sit me down and go like, you're driving the you're driving the sales forecasting because you can't be responsible for the numbers unless I'm giving you good information. So you're like, how many boot camps are we going to do? How many CFOs are we going to take? Like how many sales calls are you going to do? What's going to be the close ratio? So you're driving that, starting with the revenue on the income statement and per month, if we're going to have to predict cash at any given point. And I think that's so important because I don't see, Pat, almost ever the finance function of the CFO driving that process. They're just taking random people's word for it. And then building out all of the cost of goods and the overhead just on a whim.
Yeah. The sales team has to be responsible for the sales budget.
Or the marketing, right? Because you got Jimmy, who's like a master marketer, marketing. Yeah. So talk about leading indicators and like how you help.
And again, having good historical information, are there seasonality to your business? Is the first quarter really busy and the second, third quarter really slow, because that affects cash flow. Are we going to have to borrow money at some point during the year just to fund that? But are we going to recoup it, in other quarters? But working with the sales and marketing teams to say, okay, what's the most logical way to build a sales budget? Is it by customer, or is it like we have so many new customers, we don't know who the customer is going to be? Okay, so what marketing plans? What kind of lift are you going to get with advertising? Just understanding all those aspects of it so that you can produce as good a sales forecast, a budget, I used the wrong word there, a budget as you can. And that's where it starts. Then you got to talk to operations.
But before you go down to operations, so I like how you said budget, because like using your words that I've got over the years, budget is monthly this year. The out year forecast is years 2 through 5, but like you said, more higher level. But you before we go on to the ops, because I think that's important too, is month by month by month, line by line by line, 50-50 chance of hitting it. Those are the words I got from you. So like, can you maybe double click on that and explain it?
People who beat their budget every year, or people who miss it low every year, aren't doing budgeting right. We learned from our friend Dave Deal, Prairie Capital Advisors. He taught me, look, a budget should have a 50-50 shot of being too high or too low at the end of the year. Then you're really challenging what you're doing. So it's again, you should have goals and strategies in place. Strategies are choices. If we made choices A and D, okay, what are the financial implications? You got to build those. You got your core business, but if you've got new strategies that you're deploying, you've got to then predict the financials of those. And it's not just the income statement. The budget needs to be, like you said, month by month in a 3-statement model: income statement, balance sheet, and statement of changes in cash flow. And people are like, well, how do you predict that? It's not that hard. It's not that hard.
We'll get there, because I want to tie out to then as we kind of give you an idea where I'm headed with this is, and again, it's something we've been doing for 6-7 years now, it's the out year projections, the value gap, and then looking at the bigger picture. But the month by month, line by line, would start with revenue, where you're taking those leading indicators of sales conversions or net new calls or whatever it is. So that way you as the CFO believe those revenue lines per month, including seasonality. Then you're going to ops. And so someone that's responsible for the gross margins, whether it's production or service or whoever it is, and you're kind of walk through like how you're guiding that conversation.
Yeah. So historically, you look at these, and if you got different lines of business or whatever it is, you've got historical margins. It costs X amount to produce, $1 worth of revenue. From a gross profit point of view or gross margin point of view, but also you've got some fixed costs in there. So your contribution margins, you factor in there. Is something going to affect these? Are there costs going up? And we're constrained on the sales side. We can't raise prices that much. Tariffs could be something, the things like that are happening. But then you've got to say, okay, if they're like, okay, we're pretty much staying the course on our margins, then you can predict out,
and you're doing the margins because you're matching those margins with the revenue. Because different products or service, because like this is where, in my old business or a bunch of my clients right now, you might have multiple multiple product lines and have different margins that you want to have.
Like in your old business, you budget hardware, revenue and costs separately than your CPP, hardware and costs separately than your software. Revenue.
Yeah, I love it.
I'm not giving you anxiety.
And Rob was just on the podcast, so I love the fact that you're in the cost per copy world, man.
Yeah, but you have to do those separately because
different margins.
And is one growing faster or slower, and that's going to affect your overall blended margin. You can't just say, we're just going to pick 35%.
And that blended margin is one thing. But then it's like, and I think back to, okay, it's the thoughtful. It's like, I've got 3 different revenue or 3 different product lines here with 3 different margins, but all of them are necessary to keep that customer. And that's where those strategies come into play, going like, it's okay to have varying degrees of margin, but then you're looking at that blended margin to then, but you're going and working with that operations person or service person, whoever is responsible for the gross margin, and working with them to optimize for the target margins that you're working towards.
Yeah, exactly. It's a coordinated effort between the two. And then after that you've got sales, general, administrative, which sounds easy. It's not just rent and accounting people and all that. Sales is in there. So those costs are tied to your budget. Are you hiring are you opening a new office? Are you hiring 4 more salespeople? Is your sales market segmented into, different national clients versus local clients? I mean, you can imagine those are, differences
Because
that
if you're doing that, you're able to identify the cost of acquisition of the different product lines. So you can say, okay, well, sales compensation, paid ads, trade shows are all, and like which of those costs are allocated to which product line. So you can say, okay, how, like, because you don't want to pay a bunch of money to go acquire the lowest. I mean, like, it's just this is stuff that people just, I think, intuitively understand, but they don't know how to connect all these pieces, Pat.
Yeah, and like, in a business, we're going to hire 4 salespeople. Well, how much are they going to produce every month, and what are their margins going to be? And are they going to pay?
How are the comp plans? Which product lines?
Which
right?
product comp? How much commission? When are they going to pay for themselves? And do you make a decision? Look, we're going to be upside down on these new salespeople for the first year. It's just the nature of the business, and then we're going to expect them to turn around. Well, but then you've got something to monitor. You say, okay, Sally's been here for a year, and
she ain't sold shit.
She's still behind the 8 ball. So what to do that. So it's people think of overhead as just rent and office salaries and that kind of thing. When you throw sales and marketing in there, because that's part of SG&A, it's important.
Yep,
it's really important. But
and then thinking through, and I don't want to necessarily maybe get too into the weeds, but I think it's just so important because I think data cleanup is one of the biggest issues that I've been seeing. And like, I go back to like the clients. I was like, hey, Pat, can we help these people? Just help them make a decision on this. And you're like, absolutely not. and then now I have so much empathy of like why that was. It's because like we have no idea what the hell's going on. And they're going to make a huge bet with all this inaccurate data. But so with the SG&A and the gross margins, it's thinking through how all of this stuff connects together so that way they can make the decisions on where to scale what product line, and then how to commission people. How do you commission people if you don't understand the gross margins and don't actually believe them? And then with the overhead, what I struggle with at my old business, I mean, this will actually give you heartburn. I was actually pulling up Imaging Past old financials because I was building on that 3-statement model, which I got some more updates that I can't wait to show you. But we had all of our sales salaries in hardware. And that's why I was constantly arguing with Corey and everybody else, is because I'm like, they sell everything. It should be at the bottom. And so like the margins of the hardware were super screwed up. But then the copier technicians, the payroll and the equipment, or the payroll, the insurance, and then the cars were in cost of goods. But then the IT services, the payroll was in overhead. So I had like 3, like it was all commingled. But at the end of the day, I couldn't make any decisions. And it's more of just like set a standard so that way you can read them. Any thoughts about like how people should think about that?
I mean, industries are different. Your old industry, some people are willing to lose money on hardware just to get the cost per page business, okay. But know that. But then the allocation cost, you always want to try and match your cost against that it takes to generate revenue. Cost per page. Somebody comes in and repairs your copier or puts in supplies. Well, the cost of supplies, the cost of tech, and all the related costs.
All that is part of it.
It needs to be matched up with that revenue to get a true gross margin percentage. So, industries are different. Deciding on something and sticking with it, making the most logical, because you can have a little bit of have a little bit of interpretation as to where some of these costs go, but once you decide, have the same thing in your budget that you do in your financials, so that you can see trends and act on them when something goes haywire.
Perfect. So then we don't have to cover too much because I've beaten the normalized EBITDA drum, I think, almost to death on this, but like
not possible.
I know. Not possible. Yeah. You don't think so?
No.
Okay. So before we get to the balance sheet and kind of the full tie out of the 3 statements to get to but like, again, we're building an annual budget. You've started with sales, then to ops. Then, as a CFO, you're looking at SG&A, you're working with the other 2 function heads. And then you get to normalize EBITDA. So walk through, like, as the CFO's job, understanding normalized EBITDA and how does that involve in the budget process and the monthly close?
Yeah, EBITDA is a proxy for cash flow, but it's the metric that the valuation industry and the M&A industry uses to price the value of a company. So it's hugely important. It's earnings before interest, taxes, depreciation, amortization. The normalizing part of it comes from things like an owner who runs certain costs through their income statement that aren't essential to the operations of the business. The owner may own the building in a separate entity, and they may set the rent higher than market,
or lower,
or lower than market. Not market. Understanding those differences and getting to a normalized EBITDA. This is the true EBITDA of the business if it weren't for these other things. And business owners do this all the time, almost universally. I have one client where we literally allocate the rent. We put market rent and SG&A and the excess rent below the line so that our normalized, we focused on normalized operating income as opposed to EBITDA, but normalized EBITDA, but they're very close. We do that so that we can have a true picture, because the numbers get distorted, and understanding that normalized EBITDA is then can what drive you. What's my business worth today? And if I look out into the future, what could it be worth down the road?
And understanding those trade-offs of reinvestment versus distributions. And what I like, and I think going back to like that rent example you just gave, like, and it's what I say to all my clients, I don't care what you do, but like, if you're going to pull a bunch more money out of the business to pay, extra rent, but then bitch about the fact that you don't have enough cash to grow your company, like, I don't want to hear it. Because and it's because you're just doing two things that, are like, they're opposing each other. Yeah. I don't care that you do one of those things.
Right.
It's just like, you can't
understand the implications of what you're doing.
Right. Right.
Right. But again, it gets back to that owner hat. If I own a business, I want to grow the value of it. All businesses will transition one day. They'll either close or they'll sell to somebody else, or you'll pass them on. You'll sell them to your kids. You'll sell them to a PE firm. You'll sell them to an ESOP trust. All businesses transition at some point, and understanding at the end of the day, what value do I want out of that when that transaction happens? Just all this leads up to, and normalized EBITDA helps you focus on that.
It gets you, and I think it's important too, because it's like, it's the outside market of what it's worth, but also it's the true cost of your lifestyle. So it's like, if you're running stuff through the business, it might be, because at the end of the day, you and I constantly talk about what is the annual income that you need as an owner, as a person. Like you need 300 grand after taxes. Great. Where's it coming from now? And where would it come from in the future if things change? But on the monthly budgeting and then that budgeting, you're closing the books, going through that normalized EBITDA process. So that way, and again, even if someone's putting it on a spreadsheet, just track it. So you have the footnotes of the story. But then when you're budgeting, you're also able to budget out the forward normalized EBITDA, which the projects, like we hired, Mike from out as a recruiter, or we put in an ERP system. So as the CFO, you're also having that lens to say, we're not just forecasting out net income and margins, we're actually able to forecast out some of the one-time expenses that we're also anticipating.
Yeah. Or, 2 years from now, we expect to spend $250,000 on some special project or something that's not an
acquisition or whatever.
Or not a recurring, or, install a new ERP system, which is just kind of a one-time thing. You got to know those things. And again, that comes from your planning and what you want to do, and adding the cost of those and the resulting, hopefully, revenue of making those investments.
Yeah, because you'd have the cost in the income statement that you would have helped with the budget, but then you're taking it, and you're on that normalized EBITDA line, you're taking that out. So that way, again, if it's one of two numbers, normalized EBITDA times the multiple, they'd actually be able to peg that to something. And as you as the CFO, you're thinking through all that stuff and just connecting the dots as you're going through things. The balance sheet, because all three statements, income statement, balance sheet, and cash flow statement, are all connected. And so you're budgeting all three of them.
Yes.
You want to walk through kind of like what?
Yeah. And, businesses are different. Some businesses get money up front. I don't think Jimmy would care. Jimmy's business, people pay when they order. So you got to project customer deposits, which is unusual for a lot of businesses. But, you can you can estimate how long it takes you people to pay you. There are trends, DSO, day sales outstanding. You can estimate how much inventory you have.
Well, just to double click on the different terms people use. Accounts receivable, how fast are you collecting them, right? I mean, and if you're collecting them at 37 days or 45 days or 25 days, you're able to calculate in that day sales outstanding. What are you normally doing? And then because you're going to be able to every dollar of revenue that you sell, you can apply that model to.
And it goes in receivables, and how long does it take to turn into cash? This is all part of the cash conversion cycle. We're back to cash flow again. Inventory, how much inventory are you carrying? And when you predict that out, you can also say that's too much or it's not enough. What decisions can we make? Payables, how long are you using vendors' money? Without, how long can you use? And the goal is to use it as long as you can without damaging some relationship.
Yep.
With it, people are doing that to you. So those are the key ones. You have some prepaids and accrued expenses, but from a material point of view, that's probably not very big. But when you do that, you can then just budget a balance sheet that just looks like your normal balance sheet. When you have the income statement and the balance sheet, then you can do the cash flow statement, on a budgeted basis. And like we have a client where we have the balance sheet, this year to last year, this year to budget on the balance sheet. And then we're comparing what we thought receivables was going to be to our budget, which is pretty unusual. You don't see that very often. And the same thing on the statement of changes in cash flow. We have a budgeted cash flow forecast, and how do we do compared to that?
So here's the takeaway.
It just gives the owner a bunch of information to make
right and
logical decisions.
That's where I was going with this. Where is that the owner doesn't need to know how to do this at all. What I think is the most important takeaway is this is what has to happen for a CFO, and if it's not being done, it's just not being done. Because if you don't do this, then you can't project out what is going to be my cash position in the middle of next year. Because I had this one guy go through my workshop in June and building a $20 million plant down south. And I was like, and they don't have a 3-statement model. And I was like, dude, do you have any idea what your working capital, your payables, receivables, inventory, debt, cash, or debt, taxes, and what your distributions would be in the middle of next year? He's like, no. I'm like, doesn't that
spending $20 million?
I'm like, doesn't that scare the shit out of you? What the fuck? I'm just like, I'm sitting here going but what I think is so important is like, it's just guessing. Let's just all say it. Right. And so like I think the takeaway I want for everybody is like, what you just said is what has to happen and what the CFO has to do in order for them to see the information. And no amount of complaining or excuses is not like it just is or isn't, right? I mean, that's what I want to.
Yeah, and if you just choose to make the gamble and roll the dice,
sure, whatever.
So, okay, whatever. But nobody wants to do that. I guarantee that person has a level of anxiety that's probably pretty
unnecessary for sure,
and unnecessary to do that. These things are knowable.
And I think all the challenges of supply chain issues, inflation, and people, and remote work, all these things now are the decisions are in the cash flow statement. And cash flow is an actually constraint again, so people care. So now that we got all three of these tied together, you're guiding that the out year projections, maybe kind of give the 2 to 5 year, the value gap, however you want to kind of put this a bow on, as in like, this is what you're using to kind of the point A to point B, the impact of your decisions. How would you tie it all out in the 3-statement model that you've been working on forever?
Yeah. If, when you get your financials accurate, you get a budget for the next year, then best practice is then to have a 2 to 3 to 4 to 5 years, after that. That's generally a higher level, forecast. You're not going to budget in detail. Do we expect revenue to grow 10% a year? Is our margins going to compress or expand or stay the same?
I want to interrupt for a second. What I've been working on with the model that I want your 2 cents on here is like, some people like, they have a good idea of like, I want to increase the percentage of this revenue versus that revenue. right? Or I want to like potentially buy a company. So it's like it's kind of like the makeup of what their business looks like, but not to like the ground up budgeting like
Yeah.
you were talking
So
about.
you've got your core business, that is going to move forward. If you've got plans to introduce things like new product lines or make an acquisition or things like that, you have to roll that information into the forecast as well to see what the effect on normalized EBITDA is. When you get out there, and when you have that normalized EBITDA year by year by year at that point, that's not monthly, that's just by year. Then you can apply multiples to it that in your industry for your size of company and this market, it's a 6 or whatever the multiple is. And if you get your normalized EBITDA up past a certain amount, you can get some multiple expansion on that. You can see what the company's worth.
So you can see what the
high
company's
level
worth.
estimate.
And before we get to that value gap, because that's where that you're really, tying together that value and understand and run some of those scenarios, but you're doing that for all three statements too, right? So so the normalized EBITDA would be on the income statement. So you're kind of looking at the high level of the income statement for the next 4 years. But then if I was the owner, I said, hey, Pat, as the CFO, I'm like, hey, I would like to take $1.5 million distribution next year for a house. By the way, I want to buy a company. I'm looking at my building. I mean, so you're able to then go to the balance sheet and the cash flow statement to see, and like, how does that impact our line of credit? Because it's really a funding conversation at that point. Like, do we have the cash flow constraints visible?
Well, you want to do that, and you want to buy a business, and you want to spend $20 million to in a new plant. And here's, all of a sudden you got to borrow $30 million to do all that. Is that something and that may be what you want to do.
Where's it coming from?
Where's it going to come from? Will the bank loan us $30 million on these numbers? This kind of information really helps when you go to banks, and it helps them do their underwriting. They can, if they believe the numbers and they see you're thinking about out years, they like that a lot. But being able to put that in a form where the owner can understand, okay, if I make this choice, here's the impact. If I make this choice, here's the impact. If I A and C, here's the impact. From a cash flow point of view, because there are owners who make decisions, and all of a sudden there's no cash for them to take distributions.
Or just no cash at all,
or no cash at all. To run the business, it can be a scary thing.
I want to talk about like the outcome of this, because I think that's what's so fun is like I've watched, and maybe you got different stories that you want to add to, or it's like, okay, if we have the whole picture, first of all, anxiety down, visibility, you can actually get the independence. You can do all, like, I'm just like, subject to the world beating you up in the face, like, but you at least have something to navigate towards. But just the kind of the nuance part, like you go to a bank and you did all their work for them. And like, I've watched you take clients' personal guarantees out, and then like, because it's like, here's exactly how this is all going to fit together. And then you could go to the investment banker or the private equity firm that wants to buy you and say, here's exactly like what you've got this roadmap that everybody else can start looking at, and you're controlling the narrative versus everyone else having your narrative controlled. So, I mean, like any other things you want to add?
You're in the driver's seat. When you have this information and you understand it, you are in the driver's seat, whether it's dealing with a bank, whether it's dealing with a potential buyer, negotiating whatever it is. I had a client and we were selling the business, and afterwards, after we closed, the buyer said to me, "You guys have an interesting way of negotiating." I'm like, "Yeah, what's that?" He's like, "You don't." I'm like, "Well, that's because we knew our story. We knew what it was. We knew our numbers. We knew what it was. We knew what the cash flow in the future was going to mean to the owners.
Given everything that they wanted.
And we knew what they wanted, and given that, we didn't have to negotiate, because we were perfectly happy with what we had. We knew what was going to happen if we didn't sell. And so, it's a necessary way for an owner who wants to grow the value of their business. If somebody has a lifestyle business where all they care about is having a job that pays them $100,000 a year, and I'm not minimizing $100,000 a year, but if they say that's what I want out of this business, and year after year they can make $100,000 and they'll be happy the day that they close it and nothing happens, they don't get any value out of it. Okay, but just call it that.
Yeah, just say it, please, everybody. They can just let's acknowledge it
Just call it that. Don't do all the extra work or go through the anxiety of
and
all this.
minimize the investments too. By the way,
Yeah,
right?
milk it for all it's worth if that's your end goal.
So Pat, here's the belief that I have locked into over the last 12 months as I've leaned into the independence by design, the owner's framework, and kind of like all the people that you and I've worked with for so long is like, okay, and here's who I've identified that I really like to help. And I think you're still in that same camp too, is like, okay, it's people that have built something pretty special. So it's generally way more than a job. They've got an infrastructure, but they've got a job. So call it like 25 to 200 employees. They're usually the person at the top, whatever the accumulation of different tasks are, whether it's president, COO, whatever it is, but they've got a job, and their income and their distributions after taxes and reinvestment generally equal the lifestyle that they want, whether it's including savings or not. And it could be anywhere from a couple $100,000 to, I don't know, a significant amount. But like the concept holds true where all of a sudden they go, okay, well, I want to grow the value of this. And so I want to step out of the operations to give myself choices. But what I see is the biggest hurdle, and why everything that we talked about is so damn important, is because if they need to make, call it 25 to 50 grand a month in ownership distributions after taxes without suffocating the growth of their company, the only way for them to get the visibility into that is to do this. Because otherwise it's like, what happens is like, it's like this chasm where it's like the cash flow constraint. It's like they're kind of like tapping line of credit. They're like reinvesting, but like they're kind of looking at that K1 going, okay, but they have this desire to, have this escape velocity out of the operations, not necessarily to sell, to your point or at the beginning. Could be to do more acquisitions. It could be to keep it for a while, then an ESOP, but like, it's like this escape velocity from the operations. And so any thoughts on that? Because like, I think it's just so important that people do the hard work, because that's the discipline sets you free, I guess, is my.
Yeah. Most all choices have trade-offs. If I want to make $25,000.
Which ones don't? I'm curious, because I would like to.
I don't either. I don't know. I was just trying. I don't know. But I want to make an acquisition. Okay, how are you going to fund it? Are you tapped out on your borrowing? Are you willing to give up distributions? Are you, I talk about lifestyle businesses. I've never met an owner that would admit to me they have a lifestyle business. They all say they want to grow the value and someday reap the financial reward of a transaction. But having this information, have a working knowledge of it, utilizing it in your planning so that you can make your choices informed about the likely outcome of these. It's not a perfect thing, but at least you've given some thought, done the hard work, like you say, to say, if I do this, I'm not going to be able to take the distributions I took, and they're going to go from, I'm making up 25,000 to 15,000 a month for 3 years. Is that trade-off worth it to me? Because today my business is worth 4 million, and at the end of 3 years, it's going to be worth 12. Is that trade-off worth it to me?
Yep.
And then
what percent of confidence do you have in that, right?
Yeah,
and then do the necessary work to make sure you believe that that'll happen with the highest confidence. I
mean, we're in the business of giving advice, and people take advice and sometimes don't. That's okay. There's no judgment in it. But what I don't like is where people are making decisions and picking their choices in it without any information, without any idea what the impact is going to be.
It's that I would 100% agree with you on that. And then also ignoring the fact that there's actually trade-offs. Like I've got to this, I've been on a freaking tangent of like, can we just acknowledge that you can't have all of this at once? You know what I mean? And I just think if you were to, what's your hope for the middle market? I mean, you and I have both been doing this for quite some time, and you're like
I've been doing it longer than you. A little bit.
Well, according to you've seen the 100-year mark, and so I didn't even say it, you did. But like Like how do you what do you think moves the needle on all this, Pat, for the people that, because like you get the private equity firms who understand this shit,
They've got
but
it
then
nailed.
what
They've got
happens?
it nailed. They've got it figured out.
They do, but here's what I'm watching, and it's very apparent now is they look at these numbers, but they don't know how to call. They don't have the what I've just called the bullshit filters. So like they got the operators telling them the numbers, and then they build this beautiful model, but they have no idea to determine whether those people are actually capable. So there's this like there's a disconnect between back to the operations of what we've been talking about and what the possibility is actually getting that financial model done. But they've got the financial model. So like I think that the power is in the owner operators that you and I both know.
Private equity backs down. If you've got good information, you run the show. They may have MBAs from Harvard, but private equity firms get buyer's fever quicker than anything. And when they want something, and you
don't negotiate. Ooh, I want it. I want it.
They want it. They've got dry capital they need to deploy. They've got investors on their backs. They've got committed capital that they need to deploy, and but also when you know your numbers, you've used them to make decisions. That just tells them what you're doing.
And I think capital becomes a commodity then.
Oh, absolutely, it does.
It's just like you're just matching up the capital form of line of credit, conventional loan, private equity, mezz financing becomes a necessary. It just becomes a vehicle in the model to get you to your goal.
Because you've agreed on the numbers.
Yeah.
I can remember we were selling our company and we had our finance due diligence meeting. And I thought 2 or 3 people from the private equity firm were coming. There were 12 of them, from the bank and their CPA firm that was doing the due diligence and all that. But we knew our numbers. And for 8 hours, they would ask questions, and we had the answers.
That was like the Pat Hobby Super Bowl. Well, no, I answered every question that everyone
It's not that.
had.
It's just that we did the hard work to know this stuff because we realized how important it was.
Come on, it was validating.
It was fun. It was a blast. It was a blast. But the point is, for the owner's benefit, it put them in a position of being able to make a choice and empower them to say, "This is what I want. This trade-off is not worth it."
Yeah. What are your thoughts on so like hopefully the people listening in have already acknowledge the fact that if they're still listening and they're listening to my podcast, they have a desire to understand this to a certain degree. And then there's this gaping hole that you and I have tried to tackle in various ways of like, how the hell do you find a Pat Hobby to help you? Because so someone's listening and going like, I'm getting it. And that's why I built this financial model. I'm going to be giving all my clients to say, okay, you can at least try to like work on this, but then there's this role that needs to be filled. Any 2 cents of like, as someone who's going and trying to accomplish that, because it's such a constraint for them between what you just described as the result and where they are right now, I think it's this role that becomes a big issue.
It's hard. We tried to hire a bunch of them, and we were successful with some, I think, that got it. Just keep looking. No, and I think you told me you were helping a client interview a potential CFO. That's a good thing to do, and I think you've got a list of questions, or job description type thing or qualities. Use that and don't settle. The answers are out there, and there are people out there who can help people get this, but it may take a while to find them, and don't settle for something less than what you need.
And do you think that there's so that's it, that's if they're because I got a client right now recruiting a CFO, and it's 250 275 base plus phantoms, like a lot. I know and like so like a good CFO, and again, if you've got your clients, and so you think about the person that's capable of doing this stuff, they've got some options and choices. So like and private equity is a big competitor for the talent suck of a lot of this stuff. So like the thing that I'm curious on if you would add or change anything about what I'm going to say is like, I say to people, it's like, hey, like most of my clients can't afford the full-time CFO, right? I got a couple that are in the process of doing that, but they can, it's absolutely the right financial decision for them. And they've got a controller inside. And so there's some economies of scale, but then what you and I have seen more often than not is someone's got a controller, a staff accountant, and bookkeeper. And then it's like, okay, how do you get this level of oversight? And I think that there's probably a couple ways that people can tackle this. One is educating themselves more. figuring out, are there tools to help with the interpretation of the data, whether it's a model or something, and then to help that controller get elevated to help there's this bridging of the gap. And then if they go down the route of a fractional CFO, and again, you're fully booked. Otherwise, I'd be duplicating the Pat hobbies. Maybe there's a GPT we can actually get your consciousness plugged into AI at some point. But because that was the biggest hard thing that we struggled with, is like, I'm like, Pat taught me the gold standard. Finding the gold standard was really effing hard, and then scaling the gold standard. So like, it's kind of like we're flipping the equation, saying like the owner operator has to figure out, and if they're going to hire a fractional person, it's still the same level of job qualifications and integration. And so I don't know, man. Like, I think
it's hard. That part, business owners, one should get good controllers. That's a key step. At least then the financials are accurate, and timely and useful, as we used to say. Finding that fractional CFO, it's hard. I mean,
there's so many service providers out there that are just pretending and putting on all this marketing bullshit, and it's just like it's
and they've got something fractional CFO in their name, and when you talk to them, they're like, "Oh, we really don't do that." We're bookkeepers and controllers, but understanding what it is, listening, to your podcast and just educating themselves on what good looks like, and you just got to keep looking. But it is a difficult thing. If I had really thought about this 30 years ago,
I don't know.
When we started this, we thought, should we scale this up or just do it ourselves? And kind of chose to do it ourselves.
You were way ahead of the fractional, that whole marketplace. And
I had a friend who started in 1995 doing it, awesome. And I started in 96.
That's awesome. And one thing that I'll plant the seed, because I think that there's an opportunity for educating controllers to do this. And I've been nudging you, saying, hey, maybe there's this thing. Because I think it's like, people have controllers. And what I tend to see is like, there's really good people that are in an operating business that the owner likes and trusts, has intrinsic motivation, knows the operations, and is just missing some of the things and components that we talked about today. And I think there's an interesting leveling up, between providing a templated 3-statement model or something like that, plus then the education and guidance. I think
if there was if 20 or 30% of the controllers out there could be leveled up to be CFOs, that'd be a huge improvement. That'd be a huge thing.
So food for thought. In my Stephanie, maybe take on
spare time.
Yeah. Hey, you like to work.
Yeah.
Pat, this has been so fun.
Oh yeah. It's great doing this.
It's been really fun. I don't know if there's anybody. Well, we'll put the links to our previous episodes in it. Any other parting words or?
No.
I don't know. I don't know if you want a flood of calls, because I know that that's possible. But
but if people have questions or something, you can send them to me, and I'll do my best to help.
Careful, man. Careful what you wish for. Maybe we can have a leveraged coaching program.
Yeah, there you go.
All right. Well, thank you so much, man.
All right. Good seeing you.